Good morning. I'm with Simon Marcotte, CEO of Northern Superior Resources. Northern Superior just had some really big news, kind of made my year, actually. So I'm really happy to have this conversation with Simon. Good morning, Simon.
Good morning, sir. How are you?
I'm very, very well. Gold is up, silver is up, Northern Superior is up. Barrick had good earnings, so there's a lot to cheer for here. Look, I want to say congratulations. We know junior mining is a tough business. This is a sector where failure is actually the norm. And so when I see a company get acquired at a large premium by a major mining firm, that's just fantastic. So I want to say congratulations.
Well, thank you very much, and thanks for your support. I get from your writing that you are a shareholder, so happy for you as well.
Thank you. So what worked? What led to this acquisition? I mean, it's almost 300 million, US in total. What worked?
Listen, I really think it's the view that we have that we had on the camp since day one. That view was shared by the management of IAMGOLD as well, which was if this camp is owned by a single company or the same structure or joint venture, then there's a lot of optimization that can be done. So I think this view was shared. Mind you, when I started Royal Fox with Philibert during COVID, it was with the idea of consolidating the entire camp and going after IAMGOLD's asset, right? Because IAMGOLD was in a very different position at the time. They were having balance sheet issues and all of that, which they solved brilliantly, if you ask me. So at the end, it was too good for us. So IAMGOLD not only had the size, the capital to more than us, obviously, to advance all of this, but they also have a team that is from Quebec, right? The CEO of IAMGOLD is from Quebec. The COO of IAMGOLD is from Quebec. These guys are repeatedly proven, right? I mean, this is not the first gig Renault leads, right? He did Island Gold with the Richemont that he sold to Alamos, then worked at New Gold and all this, and now at IAMGOLD. So they really have what it takes to build something in Quebec. So it made all of sense in the world.
So tell us a little bit about the details of the transaction. When is it expected to close? And so I guess that as a Northern Superior shareholder, we're going to receive the shares of IAMGOLD upon the closing of the transaction, and then we'll get the opportunity to either hold those shares for an even higher price or to sell some and take some profits.
That's right. So the details of the transaction, for one share of Northern Superior, you're getting three things. You are getting 0.0991 shares of IAMGOLD. You are getting 19 cents of a share in cash, and you're also getting a pro rata share of the OnGold shares that we own at Northern Superior. So it's about 0.2 shares of OnGold per share of Northern Superior, or 1 share of OnGold per 5 shares of Northern Superior that you own. So there's still quite a bit of value here in the stock. So I mean, we did not sell the company to anyone. We sold the company to IAMGOLD. And you're asking me, you can keep your shares. I will definitely keep every single share of IAMGOLD that I will receive, and hang on until the same thing happens to them. I see IAMGOLD as excessively strategic, and in an environment where M&A is accelerating. I think IAMGOLD, its value is much more than the current share price. And the reason why I say that IAMGOLD is so strategic, if we start from the top, first of all, it's in Canada. And Canada is the most strategic geography right now for gold. The reason is the Canadian dollar is pretty much the only currency that has underperformed the US dollar in the past 10 months. So if you're producing gold in Canada, your margins are unbelievable right now, right? So Agnico controls Canada, but for that reason, I wouldn't be surprised if a lot of companies, a lot of major international companies would like to enter Canada. And what's the best way of doing it than to acquire IAMGOLD? But more than that, if we look at IAMGOLD and its positioning within Canada versus what Agnico is, I think from a micro perspective, IAMGOLD is also very strategic to Agnico. So Agnico completely controls Canada, right? So if we look at the largest mines, the largest gold mines in Canada, it's Detour, Canada Malartic, Meadowbank, Meliadine, Côté, Macassa, LaRonde, right? All of these mines are owned by Agnico, to the exception of Côté, which is owned by IAMGOLD. So I think if you're Agnico, you don't want to let a large international company buy IAMGOLD and own Côté for a few reasons. First of all, the next time there's going to be a mine like this available to be acquired, you're going to face competition, right? So from a long-term perspective, you don't necessarily want to let that happen. From a more short-term perspective, if somebody else than Agnico owns Côté, that could, put pressure upward on the cost of labor, right? Some people at Côté may start, new gigs, and then you end up, whoever buys IAMGOLD would look to replace these people and source people from Agnico and all this. So it can really put some upward pressure on labor. So I think it's very valuable to Agnico to completely keep a stronghold on all the Canadian gold market. And more than this, also, Agnico is now, depends on the week, but it has achieved the largest market cap of any gold company in the world. It has, I believe, the best paper out there, probably along with Gold Fields. But if we look at all the mine life of all the mines that they have very good mine life at Detour, at Canada Malartic. They have a very good mine life. Well, actually, that's pretty much it, right? If you look at Meadowbank, Meliadine, and Macassa, LaRonde, the mine life is not super long. Yes, those reserves can be increased with the drill bit, but at some point, the market wants to see potential for growth to justify that valuation. So I think, Agnico, if they want to keep this best paper, best valuation of any gold company in the world, I think acquiring Côté Gold, which has I believe 18 years mine life, makes an enormous amount of sense. So it'll be interesting to see what happens. I don't know anything than anybody doesn't. Trust me, it's not because we sold the company to them that we know anything but others don't. And I know that IAMGOLD is probably the most speculated potential M&A in the gold space on Bay Street, but I'm certainly of the camp that sees too much value, too much strategic value in IAMGOLD for the company to just grow on its own. So they can definitely keep growing on their own. They have the management to do it, the momentum to do it, the access to capital to do it. So it's just a phenomenal story, and it's not because the stock did well that it doesn't have more juice. If you look at the analysts out there, they all have targets of $23, $25 on IAMGOLD. So I think those targets will be reached over the next 6 to 12 months, one way or another.
Yeah, I mean, I could see IAG on the NYSE trading up to US $20 per share in the first half of 2026. That's kind of my personal price target. Not that it really matters much. Going to the transaction again, a few boxes have to be checked prior to this deal actually closing. So you need to have a shareholder vote. Is that correct?
Yes.
Okay. Is that happening next month?
So from a mechanic perspective, we should be filing the circular within 10 days or so. And then the vote is happening on December 10, if my memory serves me well. And then once the vote is done, then it's the approval of the court, like any other transaction. And then we can close. So we're aiming to close it before year end. But obviously, we're running into Christmas quite rapidly. So it could slip into the new year, but I think right now both sides are looking to close this before the end of the year.
And just to be clear, to get the IAMGOLD shares and to get the 19 cents per share in cash in your brokerage account, you actually have to own the Northern Superior shares on the record date on the closing of the transaction. So just people
Correct.
should be aware of that. And I actually think the IAMGOLD shares are a nice bonus to hang on for the close, because I mean, obviously you could sell at $2.06 or whatever in the market, and that's an option. But I think the IAMGOLD shares are very nice sweetener to actually get, because I'm quite optimistic on that stock as well. Simon, I wanna ask you and point something out to investors that are watching this, because what really caught my attention following the company over the last couple of years was in June. Your cash balance was down to, I don't know, 4 million or 5 million or something. You weren't desperate for cash, but obviously anytime a junior mining company with a large portfolio gets the treasury down under 5 million, you want to be thinking about bolstering it so you're not in a position of weakness. So you did a financing in June, and it was 5 million, and there were no warrants involved. And that financing really caught my attention, because number one, you did it with no warrants. Not every junior mining company can pull that off. And your chart was breaking out. And obviously, we know the gold market environment that we're in here in 2025. I imagine you could have raised 20 or 25 million if you had really wanted to, but you only did 5. So that told me, hold on, management is really valuing these shares here, and they don't want to give out too many at a low share price. That made me even more bullish. What would you say to that?
Well, I think you're right. So yeah, no warrant. It was not only for that deal. The previous 2 deals before that, if not 3 deals before that, did not have warrants either. So even when the market was very difficult, we were not issuing warrants, and we don't have any warrants outstanding at all right now, which it's not something you see every day. And I think this allowed us to participate, fully into the sector that saw some activity this year, right? So it was a lot of work to not put warrants a few years back, but I think it paid off this year. So you're right. I mean, we were not in discussions, in any type of M&A discussions, obviously, at the time that we did this financing. But we were seeing the market re-rating, and we saw the value of our assets. And you're right, we did not want to dilute if we didn't need to, which was not necessarily an easy thing to do. I mean, in the space, there's a good old saying that people say, when the cookie jar comes around, take 2. Because the fun never lasts in this sector, And that's something that I told the board of Northern Superior, which was, guys, we need to understand how powerful this cycle is and will be. And I said, I will not be managing this company on a way that's defensive, the same way we've been managing small gold companies over the last 20 years. I said, the world has changed. We need to have an aggressive stance. We need to manage the company as if gold is going a lot higher. And I'm glad we did, because we only did 5 no warrants and that limited dilution. That was the right thing to do. But it was definitely counterintuitive at that time.
Yeah, but I really want to emphasize that, because you made a good point. When the cookie jar comes around and they offer 1, take 2, yeah, we've seen a lot of that in the sector the last few months. A lot of companies raising big financings, 30, 40, $50 million. Even a few have gone over 100 million. So the fact that you only took down 5 million, that was a real signal. And I think people watching this should really take note of that. When another company does something similar in the future, what is the management team, seeing, the value that they see, and that I should appreciate as well. And obviously you can just pull up the SUP chart there, and pretty clear ascent since May, June of this year. It was steady uptrend. There were little dips along the way, but every dip was a buying opportunity. And the stock is a 4x since May. So very impressive performance there. Let's talk a little bit about the gold market, Simon. So, gold is one of the big stories of 2025. It's been an incredible performance, $1,000 rally there in the middle of the year. We've had a pullback. Gold hit almost 4,400. It pulled back to 38 and change in the last couple of weeks. Now we're up again this morning. So a bit of volatility here for sure. Has anything changed in your outlook for gold?
Oh, no. And it's happening faster than even I was thinking of it. And well, first you're mentioning the pullback. Yeah, pullback hurts, right? And it's not called the bull market for no reason. The bull is going to shake you off its back, right? So that was just one of this episode. As you know, I've put my head on the chopping block to try to send a message out there that I think gold is going to go a lot higher than what anyone else out there is talking about. I still strongly believe that this was going to happen. Now, gold started to move on its own because central banks, saw what was going to come. And it is now a slam dunk that the real rates will drop. So we're starting to see the gold stocks, the gold companies starting to do well. But they barely moved in the long scheme. They barely moved. They had an increase recently of 10 times in free cash flow, and the sector went up only 2.5 times. And now we know that the real rates are about to fall off a cliff. More precisely, the recent pullback that we have seen, not only in gold but in crypto as well, is very simple to explain. It is because there was a liquidity drain. Liquidity was being sucked out of the system by the U.S. government, who had to replenish their TGA account, right, which is basically their checking account, and they replenished it by almost $1 trillion. So that's why you saw bank reserves go down. That's why you saw the repo market liquidity go down as well. But now that the government, and that's why gold is up this morning, because now that the government is reopening, that TGA account will be spent. So that money will go back into the system. So crypto will start moving back up. Gold will start moving back up. And now President Trump is even talking about, a $2,000 check to everyone. Well, that could be another $500 billion, that could enter the market.
I want to ask you about that. So if he really does that, by the way, he has to get that through Congress. He can't
That's
sign
right.
an executive order. But isn't it one hand just washing the other? If we're doing these tariffs and we're taking in 200 billion, 300 billion a year from tariffs, and then we're doing $2,000 stimulus checks that amount to 400 billion, what's the point?
Deficits, large deficits are here to stay. That's the point, right? And which I find very interesting because, we're all thinking about what, is the AI bubble, is that going to burst? And I would be cautious. I saw Mike Berry took $1 billion bet in buying puts on the AI sector. I wouldn't bet that the AI bubble is going to burst. I would bet on gold because gold is going to go up either way. But let's take a look here at what could or could not bust the AI bubble, right? So first, if we look at there's two things that I kind of think about. It's like sentiment, fundamentals, one thing, and those things do support a bubble pop in the AI. But you also need to look at the money flow, and that does not support a pop of the AI bubble. So what I mean by that is, okay, if you look at sentiment and fundamentals, right? First, valuation. One way that the current bubble is the same as the tech bubble is all of the vendors financing, right? You basically pay your customer so that he buys your product, and everybody does it. So it's kind of so the best way to look at valuation is to just look at the free cash flow of these companies, and those multiples are almost as high as they were at the peak of the tech bubble. And another point, so that would support a bubble pop. Another point that would support a bubble pop that I'm looking at is the way stocks are reacting to companies. Like for the gold space, for example, remember, like I think 6 months ago, you and I were talking, and I said, when you see M&A now, when you see company A buying company B, the stock of company A goes up on the news. Right?
Yes.
So that changed the mindset of the boardrooms in the sector. And how many M&A deals did we see since then? 25? Well, if you look at the AI world, Meta, Facebook, just before Halloween, they announced a big investment into AI, and the stock sold off the morning after and has been selling off ever since. So I think that may change some discussions into the boardrooms where corporate boards are going to go, hey, why don't we just step back on these investments a little bit? So that also would point out to a bubble that would burst. Another point I'm looking at is Qualcomm, right? So Qualcomm came up with their own GPU, and obviously that stock spiked. But if they all come up with a new GPU, then it means that this is something that's being commoditized. And if it's something that's getting commoditized, margins are going to contract. And typically speaking, for a growth stock, when you see their margins contract, nine times out of 10, it's time to sell. So there's a lot of things in sentiment, sentiment fundamentals that are indicating that this bubble could pop. But look at the money flow now, right? The bubble that we're seeing right now is very, very different from the tech bubble of the 90s, from really what is fueling it. So in the 1990s, what was fueling the tech bubble was the fact that President Clinton, got rid of the deficit and it was running a surplus. So all of that money every year that the federal government takes out of the system to fund its deficit, the government was not taking anything. So the money, the wealth being generated by the economy every year needed to find a place to go, and it went into the tech bubble, right? And the tech bubble burst because Greenspan ended up increasing rates 2, 3, 4 times, and that slowed down the economy a little bit. The economy was not generating as much wealth, and it couldn't fuel that bubble anymore, and it popped. Today, what is fueling the AI bubble, which is really the apogee of the bubble of everything, is the absolute opposite. it is the fact that we're running extremely large deficits now that are being monetized by the Fed. And that's a lot easier to last for longer, right? It's a lot easier for a government to run a large deficit and increase the deficit as it is to lower a deficit and go into surplus, especially with the debt problem and deficit problem that we're seeing. So, you know, when you're saying this $2,000 check that could come out of this administration to go to everybody, which is, you know, not that far off the type of the first stimulus of President Obama during the 2000 financial crisis. Like, we're talking about $500 billion. Like, if it's nothing, it is a lot. So these deficits keep going bigger and bigger and bigger, and that just could keep on fueling the bubble. So all in all, I don't think it's a slam dunk that the AI bubble will burst. So like I said, gold's going to go up either way, because I think the Fed will try to reflate the bubble before it bursts. So let's see what happens.
The AI situation is very fascinating, and I think we've all just kind of accepted, oh, like, this is revolutionary, this is incredible, this is game-changing, this is the greatest thing in our lifetimes. And so it's just been widely accepted without much deeper thought. And then when you actually look at what some of these companies are spending on CapEx and their investments in AI, it's just mind-blowing. I mean, in the mining sector, when we see a $10 billion investment, that is front page headline news, that's huge. These companies are doing 20, 30, 40 billion a quarter. It's mind-blowing, and it's hard to understand where all that money goes exactly. I mean, I'm not an expert on it, but it seems like a lot of spending. They're just taking all their profits from their core businesses and they're investing in this AI with unclear payoffs, you know, like, it's unclear. And you're right, it could be commoditized. It could be they just all race to zero together, spending hundreds of billions of dollars to race to zero.
Yeah, especially at this capacity, they're building all these data centers and all that to serve AI. And what I understand is that some of them can't be put in action because there's not enough power to feed them. You also have companies out there that are borrowing and with GPUs as collateral, but will those GPU, you know, retain their value? Historically, they don't, right? So, like I said, there's a lot of things that point out, like, if you only look at fundamentals and sentiment and valuation and all that, slam dunk, it's gonna pop. But the money flow that comes from large deficits is there. It's not going away. It's gonna keep fueling that bubble. So I don't want to be saying it's gonna pop. So but I really think that the bubble now is different from the 90s. Also, from a fact that in the 90s, when the bubble popped, it was not the end of the world, right? Because the consumer, didn't disappear. People lost money in on the NASDAQ and all. Yes, that's true. But then they started to make money in real estate, and they started to, put line of credits on real estate because the interest rates were kept on going down.
Well, it was a transitory bubble. It went from the internet to real estate.
Exactly. But now, since 2008, the consumer is entirely driven by higher asset prices. So the consumer used to be driven by credit expansion. So interest rates would come off, new line of credits on your house, or your price of your house goes up, they would keep spending, right? And then starting in 2008, we saw the consumer starting to transition from being driven by credit expansion to asset prices, which was the wealth effect that Ben Bernanke put in place in order to save the world from another depression. Well, today, the consumer is almost exclusively driven by asset prices. So if the AI bubble would burst, then the consumer investment, everything's gone, right? Because, like, to your point, those investments in AI are gigantic, and it's almost, and all of the investments that are being made into the economy it's actually the AI investments alone are more for the GDP than the consumer. So the GDP, remember, it's the government spending, the consumer investments, and trades, right? So if the AI bubble bursts, you don't have any investments anymore, and the asset price fall, consumer is gone. So now you have government spending and trades, and we don't trade. So you would have only government spending at a time where deficits are already a huge problem. Like, if this bubble bursts, it will have implications so much bigger than the tech bubble that burst. So that's why I think the Fed may actually try to reflate the bubble before it bursts. So that will be very interesting. What's gonna be ahead?
It's going to be very interesting what happens in 2026, especially when Trump gets to sort of mold the Fed more to his liking. Financial repression coming to an economy and market and currency near you. Simon, I want to wrap up on your gold price target. You made some headlines several months ago with, I think it was a $20,000 or $30,000 gold price target. It's a pretty bold target. I want to get your thoughts on if you're sticking with that $30,000 price target. And, you know, I kind of want to tee it up by saying I was having a conversation with a friend of mine over the weekend, and she's not a market person really. She was asking me about the U.S. debt. She's at $37 trillion. How can our country be in debt to the tune of $37 trillion? I mean, that's crazy. And I said, yeah, it's a big number. It is definitely daunting. It's a little bit of a problem, but it's probably not as big of a problem as some people make it out to be. And let me explain to you why. And I explained to her about how the federal government owns 30 million acres of land, or even more than that. The government has a lot of assets, these aircraft carriers, fighter jets, and we've got gold, 267 million ounces of gold. So a higher gold price is actually very helpful for the U.S. government in this particular situation with this very large debt. And so a $10,000 gold price could actually be very helpful in terms of plugging the holes and the gaps in the Treasury balance sheet. What are your thoughts?
Yeah, well, I agree with you on this. So first of all, on a debt level, right, we're talking about 38 trillion. Sounds like a lot, but let's not forget that there's almost 400 million people in that country. I was not someone that was saying debt was a problem, but now we made it a problem. And the reason I was saying that debt was not a problem was, you can't ignore the wealth that's in the country, right? And only between 2020 and 2025, only during that little 5-year period, the household's wealth, right? And I'm not talking about the money that's on the balance sheet of Apple and that sort of thing. The household wealth went up by more than the entire debt of the United States in that small half a decade period of 5 years, right? So that put things into perspective. But now we made it a problem because debt now is going up exponentially. Well, the exponent is the interest rates, right? And all the tariffs and the reshoring and all of this are causing higher rates. So now that is a problem, and deficits are a problem. So let's see what happens. Now, as far as gold versus the assets of the U.S., the main reason why I say that gold will go to exactly this, like levels of $25,000, $30,000 an ounce, is because that's exactly what happened in the 1970s. So I always like to make the point that when you invest into a company, the share price will be valued as the present value of the future earnings of the company, right? But when things derail, when a stock is falling off the cliff, when a company is in trouble, the market will switch and will look at the book value of the company or the liquidation value of the assets of the company to establish a floor price. Well, the same thing is true for a currency, right? So the gold reserves of a country is really the book value of the currency. And if you look at the amount of debt in the United States, which is the amount of debt of that currency versus the value of its gold reserves, well, if you look at what happened in the 70s and you adjust where it needs to settle considering today's amount of debt, that level is $24,000 an ounce. So what I'm saying that gold is going to go a lot higher than what people think, it's not unprecedented. And I think the reason and how we're going to see that, what I've been saying is, I think President Trump is looking to install in this economy wartime financial conditions to kind of relaunch the economy. What is wartime financial conditions? It's negative real rates, right? So negative real rates is what drives gold price. So negative real rates is when inflation is higher than interest rates that you get on your money. And that did happen in the 70s. I mean, it did happen a little bit at the beginning of COVID, and gold stocks did very well there for a minute. But I think we're going to see a prolonged period of negative real rates. And the other observation, and I'll leave you with that, about this is, when you have a long period of negative real rates, it's good for assets, it's good for stock, but it's very, very bad if you own cash or if you own bonds, right? And in the 70s, obviously when that happened, gold and gold stocks did very, very well. But generally speaking, people were screaming because everybody owned cash and bonds, and people were screaming because in the 70s, the bond market was many, many times larger than the equity market, which is very different than today. Today, the stock market is almost the same size as the bond market. So if you split your investments between bond and stocks, you're likely in this environment to make more money in stocks than you lose in bonds. So the only people that are going to get hurt are people that own cash and mostly bonds, and we call these people baby boomers. So baby boomers are going to get hurt, but that's how our system is designed. When you get old, you get poor. I'm sorry, but that's the reason why the system
well, there needs to be a wealth, redistribution from the baby boomers to Gen Z anyway, right?
That it needs to happen once in a generation. And now it is the biggest generation of all that is, at the end of the working cycle. So it's just, it's sad, but that's how the system works. And that's going to take gold much, much, much higher than what people are talking about.
So you're sticking with the $30,000 call?
Next time I'll talk to you, maybe I'll move that up.
All right.
I think, I think if we readjust for the 70s, it gives us 24,000. There's other ways to look at this. But the other thing is that everything turns into a tsunami, right? There's been plenty of examples of that. There's been plenty of bubble. Why would gold be any different? When the tsunami will come, we'll go down the gold path. I think we'll see a tsunami the same way Bitcoin was or many other things were.
Final question, Simon. When the Northern Superior transaction closes, what's next for you?
I thought it was going to work for you.
I'd love to have you. I don't know if I can pay you enough, though.
No, I'm also CEO of another company called Black Swan Graphene, which has a lot going on, and it's actually quite an interesting thing. We're doing some very interesting things there, and maybe I can come back on the back of some news to explain what we're doing at Black Swan. But I think the idea here is that we still have all of the team of Northern Superior that is proven, and we work well together. So obviously, we'll try to redeploy the entire team into something new. But I'm still too young to go into the night.
Very good. Thank you, Simon.
Thanks very much.